Hello and welcome to episode 356 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm great, thanks, Andy. It's been a busy week. Mental, to be quite frank. There's been so many news stories, one of which actually makes it into this week's podcast. If you've been following us on social media, you'll see a lot of what's been going on. And the other big news story for Money to the Masses is that today, as we make this podcast, we turn 12. It's our 12th birthday. So we've been putting a lot of stuff out on social media. We'll continue to do so in the coming days and into early next week, because we've not been able to put probably quite as much as we'd want to because of what's been going on in the background. So you'll see some fantastic pieces on our social media showing the original website that we had, which was just a blog in those days. You'll see some pictures of where the concept was first created. You'll see pictures of us guys celebrating me with a very nice big happy birthday balloon. And that is one of the benefits of starting Money to the Masses off the back of my first daughter being born. So anybody who doesn't know the story, very quickly, after my daughter was born, I returned for paternity leave and, disillusioned with the world of finance and financial advice, effectively Money to the Masses was born out of that desire to help the masses. And so it means that her birthday almost coincides with the birthday of Money to the Masses. So it's quite handy for balloon sharing. So it's been a really exciting week. It's been a lot going on. And on top of that, I'd just like to say a massive thank you to all the listeners who got in touch after last week's show. So last week's show was about the difference between poor people and rich people. And it's a show that is obviously, if you put it together, it could be quite provocative to some people. And it's something that when you do a show like that, there's always an element of nervousness when we push it out because of the sensitive subject matter that we cover. But thank you to everybody who's got in touch, whether it be in the Facebook group, whether it be via social media such as Twitter, Instagram, and many of you also directly emailed me. And I'm going to respond to you all, but it's just been a bit of a crazy week. So thank you once again for those who got in touch. It's really motivating and it's fantastic to get such positive feedback that you enjoyed the show and actually it made you think. And I suppose the other thing before we move on is that it's quite exciting to see some new mugs come into the office, some new style, which is, can I give away? I suppose I can give away what they are. But for those people who completed the 28-day financial fitness challenge, we are creating mugs around that. So it will be potentially for people who've completed that challenge could have a Money to the Masses mug to celebrate that fact. So much to talk about, but we must get on with the podcast because we've got a lot to cover.
So yeah, let's do that. So what have we got coming up on this week's show?
So the first piece is going to be on investing, and every year I do a bit of an update on investing for income. So the state of play in the world of equity income fund investing and how you can generate the income from a portfolio. And so there's some interesting analysis that I want to talk about that I've carried out, as well as some insights into how funds are able to achieve what seems to be a very high yield. Plus, I look at the importance of diversifying your portfolio and going back to why investment trusts are so important to investors looking to invest for income. I'm then going to do a very quick piece on taxation on cryptocurrency. So it's something that somebody asked me. And although if you look at the markets out there, Bitcoin, for example, is taking a bit of a hammering from its highs back, I think they were in November, down around about 50%. But there are people who, since the wave of Bitcoin and the enthusiasm that we've seen in the last couple of years, that are sitting on profits or have made money, and they might not realise they should be paying tax on that. And I'm going to explain that HMRC will catch up with them. And the final piece on the podcast, Andy, I'm going to be handing over to you to talk about.
I'll be covering off what seems to be one of the biggest news stories of the week, and that's the rebates that have been announced by the Chancellor Rishi Sunak. And we're going to be talking about the two rebates, which are the Council Tax Rebate and also the Energy Bill Rebate. And I'll explain what they are. And actually, I'll dig a little deeper than the headlines that you've read to answer a few of the questions that have been posed since that announcement. So, Damien, what are we going to start with this week?
Okay, so the first piece I'm going to do is about investing for income. And we do a lot of work around growth investing. So we talk a lot about growing portfolios, and on 80/20 Investor, which is the DIY investment service that I run, that is a paid for service, that I do a lot again regarding how to grow portfolios. But there are people who want to invest for income. So they want to derive an income from a portfolio in order to live on. And what I want to do today is provide some insights that came from an update to the income heat maps that I create for 80/20 Investor members, which income investors listen to the podcast will find useful. And those who maybe not join income yet, may know somebody who's joined income in retirement or might plan to in the future. There'll be some insights in this podcast episode that you'll want to bear in mind. Now, just to explain it, with 80/20 Investor, what I do is I analyse the pounds and pence payouts from UK equity income funds, global income funds, and also from investment trusts. I do it for other asset classes too. So one of the most important things about investing for income is the need to diversify your portfolio. You don't just want to draw all your income from one type of fund. Now, of course, there are people who will build a portfolio of shares that will provide a dividend, hopefully a reliable dividend stream going forward, which they might live off. But obviously that's got an element of high risk to it because of the capital volatility. But perhaps to a certain extent, more importantly, investing directly in shares requires quite a lot of careful analysis and understanding and time, whereas investing in a fund that is run by a manager where the mandate is to provide an income stream, they will invest in tens, even hundreds of companies and use those dividend payments that come in to provide a payout to the investors in that fund. So you can build a portfolio of funds, unit trusts, investment trusts that can provide you with an income stream going forward. As I mentioned, I create heat maps. So what they do is, if you imagine a coloured map which shows year by year whether the payout from a fund has increased or decreased compared to the previous year. I also look at the rate of increase. I look at the current yield. So don't forget, yield in this instance is looking at the distributions from any fund versus its current value. And by taking all that information into the round, it helps you very quickly be able to build or construct a portfolio that's much more likely to provide a reliable income stream going forward based upon its historical ability to do so. So by looking back through the pandemic, through periods like the financial crisis, to see if funds were able to maintain that income stream. Because don't forget that you will see headlines that when there are economic headwinds, for example, or a company may struggle, they might slash their dividends. So that will have a knock-on effect, if you get lots of companies doing it, to these income funds. Now, just to give a quick recap for anybody who's not listened to a previous episode where I've talked about income investing, one way of doing it, and again, I'm not talking about direct share purchasing, I'm talking about investing in a portfolio of funds that can provide an income stream. That you might, for example, decide that you're going to keep aside 1 year, maybe 2 years worth of income in the cash part of a portfolio, say a SIP, for example, so you can draw on that when you need it. But at the same time, what's happening, the funds that you may invest in that produce income at different rates, some provide income payments monthly, some quarterly, some 6 monthly, some annually, they will drop into that cash pot, and then you will top up that balance so you can keep drawing an income. So you're not being forced to have to draw down on or encash any of the funds or investments if there's a shortfall for 1 year. So by doing what I've just suggested, you can attempt to smooth out the income stream rather than trying to live off the distributions as they come, because they come at different times depending on the fund and they can be lumpy. You could get a period where dividends are cut, like 2020, where universally every UK equity income fund cut their payouts. So if you were living a more portfolio to mouth type situation when it was come to generating and using income, you would have seen your income slashed. If you'd had this cash buffer, then you could have survived until the following year or two when those dividends started to recover and therefore the payouts from these funds started to recover. So you weren't forced to encash any of the capital of your portfolio. So with that caveat in mind, that's the theory. Now, if you want to see these heat maps, you can do if you want to get a free trial of 80/20 Investor, because like I say, they provide a very quick visual way to look at which funds are reliable or dependable or provide an income stream. Now, as a general rule of thumb, the equity income universe, so funds that are equity based, that are aiming to provide that income, tend to be the best at providing a growing income over time. So if you want to produce an income from an asset, you want that income to increase in line with inflation at least. Otherwise, the income in real terms is actually getting smaller and smaller over time. So we all know about the squeeze on our own standard of living. It's all in the headlines at the moment. If the income generated by your portfolio isn't increasing in line with inflation, you are in real terms actually becoming poorer and poorer. And you can use lots of different assets, whether it's property, whether it's bonds, and equities do tend to provide one of the most reliable ways of building a inflation-proofed income stream because dividends tend to go up over time. So when you invest in an income portfolio, let's say you decided to, then the capital value of those funds, and if you did it in direct shares, are going to go up and down. But because you're taking the natural payouts, that natural yield, you're not so bothered about the individual ups and downs of the funds from day to day because you're drawing a natural income. You're not going to draw down on the capital in any way. So you can think about that portfolio as this collection of investments that are pumping out a regular income stream which you catch and then use, but you don't really mind about the size of that portfolio at any given time. So in downturns of stock markets, then as long as the payouts are still being paid, then you should be able to sleep at night. Now, let me first just quickly look at UK equity income funds. If anybody is trying to build a portfolio, a good yield, remember yield is looking at the payouts that you've had over the last year versus the current fund price. A good yield on UK equity income funds is about 4%. So that is the amount of income that you're likely to get. So if you bought it today, that is. Obviously, the yield you get depends on the price at which you buy the fund and, of course, the payouts that have been paid out. In 2021, the yield on these funds was 4.26% on average, and it was 5.16% on average in 2020. Now, that's a reflection of the fall in share prices that we saw after the pandemic. So anybody who bought when share prices had fallen will have locked into a slightly higher yield than people now, but 4% isn't too bad at all. So if you're going to be looking at a UK equity income fund, you now know, thanks to this podcast, a rough benchmark of what would be a average yield out there. But the range of yields, depending on the funds you choose, is quite wide. There are some as low as 3% and there's some as high as 7.09%. And one thing I want to talk about on the podcast is, why does that happen? Because if these companies are broadly investing in UK equities and they're choosing companies to invest in to provide the underlying dividends from the same universe, why do they get different yields? Well, of course, the fund can be made up in different ways, but there are funds, and there'll be funds like Fidelity Enhanced Income. I'm just giving you the name of that one because it gives a clue that something else is happening underneath the hood because of the name Enhanced. And funds like that fund use derivatives to boost the income. So they end up producing yields that can be a lot higher than the average. So, for example, in the case of Fidelity Enhanced Income, the yield at the moment, as I make this podcast, is 5.68%. But as I said, there are some funds in this space that can give you 7%. Now, how do they make that difference up? Now, the way they do it is they use something called covered call options. And what these are is essentially the fund manager using a strategy to boost the income that the underlying portfolio will naturally yield. And a call option, just so people understand, is where you sell the right but not the obligation for someone to purchase a share, for example, at a set price before a certain date, which is the date that the option expires. And you charge a fee, which is often called the premium, set at an amount per share. So what happens is that in this instance, if the price of the stock stays the same or drops, then the option will expire with no value and you keep the premium because the other person isn't going to exercise their right to buy that share from you at the higher rate because the current price is much lower. If it had gone the other way, then what would have happened, and when I say the other way, let's say the price had risen, then what would happen is the person would have said, right, I'm going to use that option to buy that share at that set price that we agreed, because the current price is even higher than that. And what it can mean is the person who sold the call option can be forced to end up buying the share at this inflated price now and selling it at the price that is agreed under the call option, which will be probably lower. And it means, therefore, they end up usually losing money. Now, that is how a call option works. But what is interesting, there is something called a covered call option. And why this is useful in a world where you're trying to boost income in a conservative way, and particularly attractive for those in retirement, is that you own the stock. So you already own that share. So in this instance, a fund manager would have a covered call option. So they are effectively selling the right, but not the obligation, for somebody to buy that underlying shares at a set price before the agreed date, and they charge a fee for that. Now, if the price of the share stays the same or goes down before that option expires, then all that happens is the manager keeps the premium and the contract expires worthless. And that premium is how they will boost the income that's provided by the fund. Now, if the price goes up, then of course the manager will end up having to probably sell. But because they own the fund, then hopefully, if the price at which they're forced to sell because it's under this agreement, then the difference between what they have to sell it at and the price at which they bought it at will result in a profit for them. And of course, there is still that premium which is paid for offering this call option. Then what it does is it may provide a profit, but it actually limits the potential losses that can happen because they owned the share. So all you've got to understand is that some of these funds are using a strategy like this to be able to boost their income. So the reason I tell you this is that when you look at funds and when you look, God blimey, that yield is very high, I want that fund, what it is it's a fund that is using a strategy such as a covered call option to boost the income, but is very dependent on share price moves. It's not necessarily risky. It can be a conservative way to boost income, but it therefore means that it isn't guaranteed in any way and it won't necessarily be reliable. And to prove that to you, the Fidelity Enhanced Income Fund, when I analysed the annualized growth on average over the last 5 years, so that includes the year of 2020 when funds slashed their payouts. But if you smoothed it out and said, well, how much on average did funds grow their payouts over that period of time? In the UK equity income sector, then Fidelity Enhanced Income's growth of payout was one of the lowest. And that's because it's using this strategy. So the message is you need to look at the yield that you could be getting, but look at the growth over the last few years as well, because over time you want your payouts to grow. So if you just rely on something that's using these options, you'll probably get a higher income in the short term, but you probably need to mix things up a bit if you want to try and grow your income over time as well. So just to give you a bit of context of where we are in the world of UK equity incomes generally, then the average fund grew its payout by 6% in the last year. So that's pretty good. That's above inflation. But you've got to bear in mind that in 2020, on average, they cut their payouts by 30%. So we're still down on where we were before the pandemic because we're still in this recovery mode. And if you looked at the annualized, so let's say you'd been holding a typical UK equity income fund for 5 years, then your average annualized rate of income growth would have been negative 3.5% over the last 5 years. And yes, that was with the pandemic. So it's very, very unusual. But the point is that you can still, even in that instance, you are marginally down, but typically they are able to grow their payouts over time. Now, let's jump to global equity income funds, because this is important. It's about diversifying your portfolio. The average yield on these at the moment, when I look at it and analyze all the payouts, so I go through all the funds and analyze all the payouts and look at their current yields, then the average yield is 2.91%. So that is lower than the UK equity income funds, but the range is much wider. It goes as low as 0.2% to 8.67% yield. So that means that if you invested £100,000, then there's going to be quite a range of potential payouts that you're going to get over that year. Broadly, you could get somewhere heading towards maybe £8,000, or you could get less than £1,000, depending on the funds you pick. So it's important. But again, you've got to look at that average growth over time. Now, the difference is that there were 3 funds in all the ones I looked at that actually managed to grow their payouts during 2020. So during the pandemic, that is the difference between global equity income and UK equity income, is the ability to diversify, and means that some funds did grow their payout. And it's important for you to diversify your income streams in your portfolio, not just in a growth portfolio as well. It's important to do that with an income portfolio. On top of that, the 5-year annualized growth of income on these funds, on global equity income funds I'm talking about, across the board on average was pretty flat, and that's including the pandemic and the impact that had on the global economy, when even global equity income funds had to cut their payouts on average by 14%. So what I want people to listen to and to really take away is that if you build a portfolio, you don't just have to stay with UK equity income funds, but they are a great way of providing a growing income over time. Diversify into something that's global equity income funds as well. Go global with your portfolio. The yields will vary, but you'll likely produce a reliable income stream. And the final thing I want to really talk about is investment trusts. So investment trusts, if you analyze those funds and you look at how their income streams have performed or how reliable they've been over the last few years, the message really is that if you want to build a portfolio of funds that are going to produce a reliable income stream, then investment trusts have got to be in there, because there are multiple reasons why they are good vehicles for providing a sustainable income stream. I mean, firstly, managers are able to hold back up to 15% of their annual income, their gross annual income, in reserve that can be used to help smooth the fund's income payouts to investors in the future and maintain them year to year. And if you look for their revenue reserve cover, which you can normally find on fact sheets, and you can find it on the Association of Investment Companies website, we'll put a link in the show notes, and you can see that reserve cover, which is effectively how many years worth of dividend they can afford to pay just from existing cash reserves. So that will show that funds, some of them run in excess of 1 year's worth of coverage. So that is obviously a benefit. Unit trusts can't do this. And also, there are ways that they can charge some of their fees against capital rather than income. So basically, the design of investment trusts works that they can smooth out income streams by holding back some of the income they receive, which unit trusts can't do. And so when you look at that, it's therefore unsurprising that there are plenty of investment trusts that have never cut their payouts over time. I mean, we're going back some of them decades, and they grow them year on year. And the average investment trust that I looked at, so it's quite a broad universe I looked at, including UK, global, even going into Asia and North America. On average, they still grew their payouts by 2.93%. And that's the universe that I looked at. That's not across all investment trusts. And the current yield is roughly about 4.26%, which is better than what we saw in the UK unit trust, better than what we saw in the global unit trust. And the other thing is there are a number of investment trusts that even grew their payouts during the financial crisis. Now, I'm not recommending any of these funds, but just so people can go and have a look at them and go and see that they do exist. The Janus Henderson City of London Trust is a really good example of an investment trust that has consistently grown its payouts year on year on year, gives a yield of about 4.76%, and its 5-year annualized growth that I've calculated is about 3.5% in its income year on year, which obviously is in excess of, well, not inflation as we talk now, but the long-term average for inflation is about 2%. So there are others which I won't mention on the podcast. You can go and look at the heat maps if you want to. But again, the message, don't just focus on yield. Do diversify your income streams by investing outside of the UK. Do look at investment trusts in particular and dig underneath the hood to see if they've got enough money in reserve to potentially maintain payouts in a difficult year. And I think if you do all of those things, then you should be able to build a portfolio that can provide a growing income stream. And the yield may be a little bit less than you want it to be, but hopefully it will grow over time.
Okay, and so moving on to the next piece then, cryptocurrency and tax. It's complex. Damien, you're going to give us some insight.
So some people have been in touch and asked about cryptocurrencies and tax. And there's this myth, I think, that's out there that cryptos like Bitcoin, that you don't pay tax on them because they seem to be operating in this almost alternate universe. And that's simply not true. If you're going to just take one message from this part of the podcast, is broadly speaking, they're taxed in the same way as equities are, so shares. And even though Bitcoin is struggling at the moment compared to its recent highs, there are some people who will have made money probably down to luck, maybe they might argue, skill. Now, I want to quickly run through what the rules are. As I say, broadly speaking, it's the same as gains on equities. So if you've sold any cryptocurrencies and there's been a gain that's in excess of 12,300, which is the current threshold for your capital gains tax allowance, then you will likely be liable for capital gains tax. Now, if you don't dispose of your portfolio of cryptos, then there won't be any capital gains. It's the same as I said with shares. If you keep growing a portfolio and you don't actually dispose of anything, then you won't be charged tax. But then once you do at some point in the future, then you could be liable to capital gains tax depending on what you sell it for. Now, some people might be sitting there thinking, well, I've actually just gone and bought another cryptocurrency with the original holding that I had, or they went and exchanged it for some other goods or services. Then if that is you, then in all likelihood, you've made a disposal for CGT purposes. And so you could have triggered a liability there. And one of the things is that I know people think that cryptocurrency might be something that is decentralized. Yes, that's true. But HMRC is now getting information from crypto exchanges about the transactions that are occurring. And HMRC is in fact writing to people to say, I think you may have a potential tax liability, or basically getting them to think about whether they do, notifying them that they are aware that they've had transactions in cryptocurrency. It doesn't mean you necessarily are liable for tax, but it's an FYI. Now, if you have gained in excess of that £12,300, then you need to include that gain on your annual tax return. And if you don't do an annual tax return, then you will need to register and include it. Now, if you've done a tax return previously and you've realized that you should have included one, having listened to this podcast, then you need to get in contact with HMRC, because there are potential penalties for not disclosing gains, but the penalties do depend on circumstances. So you're better off, I'm not going to go through the penalties, but you are better off engaging with them as early as you can to avoid penalties that could be in extreme up to 100% of the additional tax. Now, as I say, you can talk to HMRC and it is possible to potentially mitigate that. But the other thing is that you should be aware that if you sold some cryptocurrency and you've made a gain, then you also have to disclose it if the proceeds are in excess of 4 times the annual allowance for CGT. So that's just the proceeds. So that number is 49,200. So be aware you could still have to do a tax return even if you haven't made a significant gain. The message is, if you are unsure, talk to an accountant, speak to HMRC. There is another instance where you could potentially be liable to income tax if you are deemed to be somebody who is regularly trading cryptocurrencies. So effectively you become a crypto trader, then your activities could be liable to income tax. So bear that in mind. Now, the CGT rate you'd pay depends on the income tax band that you're in. So if you're a basic rate taxpayer, that CGT rate is 10%. And if you're a high rate taxpayer, then the CGT rate is 20%. And we'll put a link in the notes to the official guidance so you can see how it is actually calculated, rather than me go into a number of examples explaining it on the podcast. So there you go, Andy, short and sweet on tax on cryptocurrencies. But make sure, if you are a sophisticated investor and you are engaging in cryptocurrencies, that you do not forget to notify HMRC when you need to. But then on the plus side, I have to just quickly say is that, like people who invest in equities, there are ways you can mitigate your CGT liability over time by staggering any sales that you have. But that's a subject for another day.
Okay, and it falls on me to finish off the pod with a very small piece. And unless you've been hiding under a rock in the last week, and it's unlike us to cover something that is effectively quite newsy, but it's a big story this week. Energy bills are on the rise, the cost of living is on the rise, inflation's sky high, and there are lots of questions that have been posed off the back of the announcement by Rishi Sunak this week. So what has happened? Well, the announcement came on Thursday that the government is going to intervene and try and help families with the rising costs of energy bills in the form of 2 rebates. And I'll explain what those rebates are. You probably already know, but again, I'll just do a summary of that. And then I'm going to cover off some additional FAQs, if you like, extra things that have come sort of hours after the announcement where people have started to think, well, hold on, what about this scenario? And I'll try and cover those off very quickly if I can. So firstly, we've got the Council Tax Rebate. Now, what is this? This is a rebate that's going to happen in April for most people, and it's going to happen for those who pay council tax and are in council tax bands A to D. Now, you can find out which council tax band you are by going onto the Gov website, and we'll actually put a link to that in the podcast notes so you can go and check that if you haven't already. And those council tax bands A to D account for around about 80% of households in the UK. I say the UK, but there is slightly more complexity to it because there are different rules for different devolved nations. We're going to actually focus on England in this particular piece in the podcast because that's the information that we've got to hand at the moment. Now, the rebate is going to be in the form of £150 credit that's going to be automatically applied to council tax bills, again, in that band of A to D. Now, for those who pay by direct debit, it's going to be super simple. Your local authority will automatically put £150 credit onto that bill and reduce whatever is owed that month. And that actually does pose one of the FAQs that came up after the announcement was made. There are people that are in that band that actually have a relatively low bill. And actually £150 would mean that it goes into sort of negative. So what would happen in that scenario? Well, we've been assured that the local authority will be able to apply that to the April bill, and then any leftover balance will be carried over to the following bill. So you should see a credit carry over onto the following month. And another question came on that. What about people who are living in properties that fall in the category of A to D, but they don't actually pay council tax for whatever reason? There could be a few reasons why they don't pay council tax. They could be renting, and maybe they've got an agreement with their landlord that all the bills are packaged up and so they handle the council tax and all of those kind of things. It could also be that they're on low income, they have disability benefits. So although they don't pay council tax, they're still going to have rising fuel bills. So how do they get their hands on this extra money, this rebate? Well, the good news is there's an extra pot of money that the government has put aside and handed out to the relevant local authorities throughout England. And it will be the jobs of the local authorities to apply those funds to the people who need it. Now, information is a little bit scarce, but what we would say to people is if you fall into that category, you need to be a little bit proactive. We wouldn't suggest knocking down the door right now because this has literally just been announced. But as April gets nearer, we would suggest getting in touch with your local authority and explain your situation, who you are, and that you'd like basically some help. And they should be able to do something for you and access that pot of money and allocate those £150 rebates to you. As I say, there's no guarantees at the moment, but the information is that you'll need to effectively be a little bit proactive in trying to get that rebate. Of course, that rule also applies, and that pot of money is also there for people who are actually in council tax bands E to H, because there may be people that they're in a big property, but they're on low income and they may well be struggling. And there is, again, that pot of money set aside for people, and that will be done on a case by case basis. So if you're on a low income, but you don't fall in the A to D bracket and you think, well, hang on, we could really do with some help, speak to your local authority when April's near, and you should find that someone will be able to help you. Whether or not you'll qualify for the rebate, that remains to be seen, but at least you can have that conversation. So that's the council tax rebate, and that's £150 happening in April or just after. And at the same time, there was another initiative that was announced by Rishi Sunak, and it's an energy bill discount. And it's going to apply across England, Wales and Scotland. Slightly different rules for Northern Ireland, which we won't go into detail in the podcast. And it means that every household will receive a £200 cash discount on their bills in around October. They've said October, and I'm sure that will happen, but obviously we've got to get all the energy firms on board and get this worked out, but it should happen in October time. So that £200 discount will arrive as a credit on your bill. The idea being that it's going to help people spread the cost and make it more manageable over the coming months as energy bills are on the rise. Now, this is a discount, but actually it should effectively be called a loan. And actually there's been a lot of talk in the media. This is effectively a buy now, pay later loan, because you're getting the money up front and then you're having to pay it back over time. Now, how will it be paid back? Well, it's going to be paid back over 5 years, and it'll work out to approximately £40 per year, around about 10p a day, added on your bill as a standing charge. So whether or not you get this rebate or not, everyone's going to have to effectively pay this standing charge going forward. So yeah, great. It's a good idea. People get a little bit of cash just before winter credited to their winter bills, but this will need to be paid back over the next 5 years. So whether you like it or not, you're getting a loan from the government and you are going to have to pay it back.
So interestingly, that could lead to bizarre cases then where there could be somebody who is a first-time buyer, been living at home maybe with their parents or weren't paying bills or something like that, who then becomes a bill payer because they get a new house or something like that, or they move rental properties where they might be explicitly paying the bills themselves, that they'll be paying this standing charge over time. As you say, it's not going to be a huge sum per month, but they haven't never benefited from the £200 discount up front. So it's again one of these systems, it seems to be, that is fraught with elements of unfairness in there, and there's going to be some people who will not necessarily benefit from it.
Yeah, it's a very strange situation, and I don't think this is the last we'll hear of these measures. I think it's going to evolve over time, and actually Ofgem have announced that they're looking to move the period from which they review the energy price cap from 6 months potentially down to 3 months. And that's not so that they can necessarily hike it up. It's so that they can, be more reactive to what's happening in the oil and gas industry. And actually, if it needs coming down, they can also bring it down. So I think that's maybe a sensible idea. We'll wait to hear more on that to come. So that's it. That's the discounts and the rebates that have been announced by the government, and a few little FAQs to tidy up some of the bits that didn't quite make sense.
Yes, if you have any other questions, then do feel free to write in and we'll try and find out the answers. But it was interesting to see as well, keep listening to the podcast, because the amount of the rise in the price cap that was announced, if you recall, if you go back a little bit in the episodes, I think before Christmas, I actually said it was going to be broadly in that line, hearing on the grapevine unofficially. So if we hear more about what it will be going forward, then of course we'll let you know on the show. So I think that's it for this week, Andy. Happy birthday to Money to the Masses. Maybe we should finish the show and close out with some birthday music. I think we've done that in the past. So 12 years. I'd just like to thank everybody who listens to this show, who's reviewed the podcast. So please do continue to do that. And people who write into the team, send me emails about the shows and feedback generally. It makes a massive difference to the office because we send them around, we let people read them, and it's very motivating for people to get that feedback on all the hard work that they're putting in behind the scenes. And so thank you for all those who have supported us, Facebook groups, Instagram, whether you listen to the podcast, please continue to do so, and hopefully we've got another great 12 years ahead of us and more.
And so that's it, Damien. Until next time.
Until next time.